you must have well over 1,000 companies that you're invested in, right?
And that's the beauty of it, isn't
That's
it?
the
It's
power of it.
diversification within this one thing, right?
And it's professionally managed and it's cheap. Warren Buffett very famously said that his wife should just buy an S&P ETF and just walk away.
What are there, 10, 12,000 ETFs out there?
Yeah,
There's a lot in that.
There's a lot, yeah.
The conditions that we have been in for most of the last decade have been very favourable to letting the market just do its work. There will come a point when those conditions change, and then it will be very interesting to see what happens in the next 5 or 10 years after that.
Welcome to Investing Unlocked, making money make sense with me, Georgie Frost.
And me, Simon Lambert.
And joining us today is Steve Palmer, Head of ETF Solutions at Royal London Asset Management. But first, Simon, do you have ETFs in your portfolio?
Please say yes.
I actually do not have any ETFs in my investment portfolio. I have in the past had them, but I don't have any in my stocks and shares ISA. I don't have any in my pension, interestingly, because my workplace pension doesn't offer any
Correct.
ETFs. It's all open-ended funds.
Yeah, that's common.
I have 3 ETFs in my portfolio, and I'm just going to read you the first. I won't go into too much detail, but just let me tell you one that I've got in there. The Vanguard Funds PLC FTSE All World UCITS UCITS ETF USD distributing GBP VWRL. By the way, the UCITS is undertakings for collective investment in transferable securities. Now,
Nice and neat, right?
isn't it just, Steve? Steve, welcome. You have kids. I say
Yep.
kids, they're young adults.
22 and 24.
But the perfect,
yeah.
perfect people to start thinking about this sort of thing. How do you explain to them what is an ETF?
So when I explain, or if I'm at a dinner party, or if people say, "What do you do?" and I go, "I'm in ETFs,"
Yep.
or if I'm explaining it to my kids, as you say, and an exchange traded fund is a fund which have been around for over 100 years, professionally managed by a fund manager, diverse investments, but the ETF is the new technology, if you like. I always describe an ETF as just a piece of financial technology, a piece of fund technology that kind of did something or brought in a new utility that didn't exist before. And that's the exchange traded part. So that means that instead of having to go to a fund manager to buy your funds, you can go to your broker or you can trade them on the exchange. So it's that accessibility that's different. If we think about films, my favorite film at Christmas is Elf, for example. So Elf,
Good choice.
Good choice, right?
A Wonderful Life, I would have said, was the best. But
when Elf came out, it was just available on DVD or maybe even VHS. I can't remember the year of it. But then a new technology arrived, and that was the ability to stream. So we had the firms like Netflix that came and did things. So they came in and disrupted. They introduced new technology. The film is still the same. The investments are still the same, but how you access them is different. And I think that's how I would think about an ETF. The ability to stream it, the convenience that the technology allowed for is rather similar to an ETF. How we consume those products and those strategies that the fund managers are producing is digital. It's become it's modern technology, and it's just accessibility and convenience. That's really it. So the ability to trade a fund on an exchange or through a broker or through a platform, that's really the new technology that the ETF ushered in. And by the way, the ETF is actually 30 years old, so it's not new technology, but in terms of financial tech and how it takes a while for these things to bed down and grow and then get to the scale that they need to be at, we're still moving in that direction. But yeah, they're not new, but I think for a lot of investors, they're pretty new.
Simon, how would you explain this to my 13-year-old nephew?
It's a way of taking your money and putting it together with other people's money, and then you invest it. And by investing it, you're putting it into something that you're hoping is going to make you more money.
Yeah.
Because it might be invested in a company, or it might be invested in a basket of other assets, and then you start getting to the complicated bit where the eyes glaze over.
Right.
I do think that, going back to a point that you made, Georgie, that an ETF, I think, is very much a kind of does what it says on the tin investment. But the stuff that they write on those tins is really confusing. I say that as someone with over 20 years of financial journalism experience, because your ELF ETF would actually be ELF, UCITS, US distributing,
all these, and these are legal structures, right? So you need to explain, yes, this is a UCITS versus an OIC, for example, which is the UK version, and they're very different, right? And so it's important, but I do agree, it does seem to overcomplicate things or make it a little bit harder to understand than it necessarily could or should be, I think. So, our job is to kind of work around that and help clients understand exactly what we're trying to say. And I think there's a lot more we can do. But it is important. I mean, the UCITS is the umbrella under which ETFs in Europe are. That's the recognition that they need to be under.
So that's a regulatory piece.
It's a regulatory piece, yeah. So when someone looks at a prospectus, they can see that it's UCITS, then it gives them the confidence.
So as an investor, I can go buy an ETF from anywhere in Europe.
Yeah.
And that's absolutely fine for me, kind of thing.
Yeah, obviously it needs to be the right ETF for what you're looking to achieve, but you're protected in the same way. I mean, if it's UCITS, then you know that it's a company structure, so it's ring fenced, and that gives you the security to know that if should anything happen to the asset manager, your fund, your assets are completely safe, etc., etc. So that's the important thing is that security of what you've owned. It's been protected and it's ring fenced, etc. All those really important points around the whole reason why the funds exist in the first place is to offer that client protection.
And is it slightly more complicated if I want to go buy an ETF that's listed in America?
Yes. So you can't, basically.
I just want to go back almost to the start. What problem were they trying to fix? Why did they come about? You said they've been around for 30 years. Firstly, why did they come about? And secondly, why are we sort of almost talking about it now as though they're these brand new things?
So I love this. So I'm a bit of an ETF nerd when it comes to the history and why they exist. And
I've got a person who loves their job, so that's good.
So if you remember in 1986, there was that big storm.
Too young.
Yeah. Yeah. I do remember. It's the one where,
I remember the big storm.
It's the one where Michael Fish said, "Don't worry, nothing. There's nothing." And there was a terrible storm, and it actually. I'm from Sevenoaks, and it completely flattened all the oak trees in Sevenoaks, famously. But the day after that was Black Monday, and that's when the stock market crashed, and the basically the SEC. Did a review of what was happening at the time and why the markets were crashing, and they came up with a series of interventions. One of those was trips, so that when the market dropped, they would pause the market, and so that was the first time you had these triggers in. But the other request was, we need a product, particularly for retail, where they can sell a basket of shares on an exchange, but sell the entire basket. So portfolio trading, which is the ability to trade a basket of equities, for example, or a basket of bonds, that was in its infancy. But the ability for retail to achieve the same thing just didn't exist. And so some bright spark called Nathan Most, who was working at the American Stock Exchange, kind of responded to that, and he came up with the idea of an exchange traded fund. So he thought about the mechanics that you would need to bring to put into a traditional fund to make it exchange traded. So that's creation redemptions, the introduction of the secondary market participants, the market makers, and authorized participants, as we call them. So he came up with this great idea and came up with the first ETF, and that was back in 1993 was when they came up with the first ETF, and that was the SPY, the huge behemoth of an instrument. It's the biggest. I think it's up and around the biggest ETF. It's probably close to 800 billion, I think, in assets. So specifically, the ETF was created to offer clients liquidity when they needed it most, when they, during stress events, and price discovery, i.e., the ability to know exactly what it is that you can sell or buy at that particular time. So that was, as I say, back in the late 90s, and then the first ETFs listed in Europe around 2000. They've done just that. I mean, people talk about what would happen if an ETF went through a stress event. Well, actually, ETFs have been around through loads of stress events, and I just think back to even COVID, like 2020, when what we saw there was that the bond ETFs were seemingly trading at a discount, and you had all these, and some very good newspaper articles were saying, "Oh, the ETFs are broken; they're trading at massive discounts." And actually, what was happening was that the market makers who were making the prices in the ETFs were actually pricing the ETF risk where the bonds should have been. And it was actually the bonds that were frozen. There was no liquidity in the bonds. So the ETFs were actually telling the bond market where the bonds should be priced. And that's actually what happened. When the bond markets calmed down, the prices that they were trading at started to reflect where the market makers were pricing the ETF. So they have really stood the test of time, and they've done exactly what they were designed to do time and time again through these different stress events that we've had, and they've provided price discovery and liquidity when we needed it most. So that's where the idea of the ETF came from.
And it's been called the Great Democratizer.
Yeah.
Does it deserve that title?
I think so. So I think we would level that at the ETF for a few reasons. Transparency. So the one cool thing about the ETF is that you have daily transparency, so you can see exactly what's in there. It's a bit of an accident because it needed to be daily transparent, so the market makers knew exactly what was in this fund so that they could make prices, because that's their responsibility. But as a result of that, everyone can see it, and that's nice. Accessibility, again, they're exchange traded, so it's very simple. You can trade them. You can see the prices, through different mechanisms, or in your on your phones and so on and so forth, or you can use them on your phones. And also, I think they're fair in terms of how they charge. So, a traditional fund, when you're buying and selling, the costs of that transaction are absorbed by the fund holders, which seems a little unfair. It's, but whereas an ETF, because of the mechanism that was introduced through this creation redemption, or through the secondary market, the market makers who are providing the prices to the end clients, if you want to buy an ETF, you pay for that execution yourself. It's external to the fund, and I think that's really fair. And the other thing I think that's really fair about the ETF is the fact that every single investor is treated completely equally. So you can't charge a huge pension fund or a sovereign wealth fund anything different to what we would be charged. So that's why I think they are very democratic investment vehicles, because I think they're transparent, cost effective, and fair.
Simon, whenever sort of I hear ETFs mainly talked about in the news, it tends to be the sort of the ones that track, global index, those types of ones. With that in your mind, you have sort of passive investing. So what role do ETFs have with asset managers then, if it's viewed as sort of a passive thing?
Well, I mean, if you think about in terms of passive funds, they will be run by a fund manager. The fund manager is just choosing not to put an active fund manager in there, trying to pick winners and avoid losers and so on. But with an ETF, we think of ETFs as being synonymous with passive investing, but they're not. You get active ETFs as well, and active ETFs are becoming increasingly common and increasingly popular. They're still a niche within a much bigger universe, but when you go for active investing, still people are often going for what we call investment funds, open-ended investment funds, or also in this country, investment trusts are very popular. But active ETFs are becoming, increasingly popular, and there are some very well-known ones. I mean, the Cathie Wood's ARK funds are ETFs, aren't they?
Yeah, and I think you're spot on. I think they are synonymous with passive investing, but I think that's just where the ETF started. There is a fund manager, and they work hard and to basically mimic what they're tracking, the benchmark, as we call it, or the index. So, for example, we have a FTSE 100 ETF that's tracking the FTSE 100 benchmark. It's like the Premier League of UK stocks, and the fund manager is spotting which companies are getting relegated, which companies are getting promoted, and that's their job. But they're simply just reflecting what's happening in the index that they're tracking. But as you said, I think that's just where ETFs cut their teeth or proved themselves, because it was the obvious place to start. They ushered in all this cost saving and the transparency and all the other things. But as I said at the beginning, an ETF is a piece of wrapper technology, fund technology. It's something that you can put other things into, so those strategies don't have to be passive strategies. As you say, they can be active. They can be very active, as in a traditional stock picker making decisions daily and about what's coming in and out. Even hedge funds could, at some point be interested in using them, because they're just access to their strategies at the end of the day. The European ETF market is about 3 trillion, probably slightly more than that now. only 100 billion of that is inactive because it's kind of the new area. It's the new interesting area because active managers are now going, okay, this ETF is what clients are liking. They like the fact that they can trade them on the exchanges. They like the utility, therefore. We're seeing that in their droves in the US, and we always look to the US as to where we're potentially heading in the UK and in Europe. So they're swapping traditional funds for ETFs in their trillions. And we're seeing that pattern here as well. And so, it's just about convenience. And the ETF offers, we think, that utility that people are looking for. And what you put into it is anything, anything that qualifies under the, it needs to be qualifying under the UCITS. But if it does, then you could put active strategies and anything into them.
So what aren't you allowed to put in an ETF?
So in Europe, for example, part of the UCITS is diversification. And that makes sense to me because we like the pooled investments, as you described at the beginning, are great because you get this natural diversity of holdings. So you're not exposed to one company, and that's the beauty, I think, of buying funds. Funds naturally give you a security in the fact that you don't put all your eggs in one basket, effectively. But you can buy a gold ETC that looks and feels like an ETF, but it's not. So you can't have a gold ETF. Not here. You can in the US, again, different set of rules and regulations. They don't have that same diversification that we do here. But in Europe, yeah. So you need to meet the criteria. But outside of that, the great majority of what you can put into a fund, you can put into an ETF. I would also say that you need to make sure that you're not constrained by liquidity. So we're talking about, they're very topical at the minute, is private equity, infrastructure, and all these other things, physical assets. There's limitations there, right? Because they're not liquid, right? These are not exchange traded things that you can quickly sell if you need to. They're buildings, and that presents a challenge. So I do think that there are some ETFs out there that are looking to create exposure to that, which is interesting. But I think we need to be careful about what we put into some of these things. So it's not for everything, but where it does work, I think it works very well.
Before we carry on, a quick word from our sponsor, PensionBee. If you're listening to this podcast, chances are you care a fair bit about investing and making the most of your money. But here's the thing, you don't have to be a pensioner to care about your pension. In fact, the earlier you pay attention, the more powerful it can be. Your pension is likely to be one of, if not the biggest investments you have, yet it's often the one people ignore the longest. That's where PensionBee comes in. They're a leading online pension provider focused on helping people build confidence and take real control of their retirement savings at any stage of life. Their app and website make it easy to combine old pension pots, manage contributions flexibly, and see exactly what's happening with your money all in one place. You can also access your pension from age 55, rising to 57 from 2028. If you want to take a more active role in your pension investing, download the PensionBee app or visit their website to get started. Remember, when investing, your capital is at risk. I want to focus on the retail investor, the everyday investor like Simon and I. Simon doesn't have ETFs. I do. I have 3. Do you need them in your portfolio? Could you just have one and that be your portfolio?
Warren Buffett very famously said that his wife should just buy an S&P ETF and just walk away. And that's kind of the mantra of, so yes, you could, but I think the beauty of ETFs is that you don't need many. You can, like your 3, for example, sounds interesting, right? You've got a bit of emerging markets.
I don't know what the interesting is like, interesting. I have global, I have Europe, ex-UK.
But you've thought it through, right? So you bought the world, and then you went, that's a bit US heavy, so I'm going to increase a bit of Europe. So you've tweaked but I mean, you must have within your 3 ETFs.
I have some other stuff in there as well.
You've probably got, you must have well over 1,000 companies that you're invested in, right?
And that's the beauty of it, isn't it? It's diversification within this one thing, right?
And it's professionally managed, and it's cheap, and you can, if you wanted to increase your European exposure, or you could do that, right? You could just buy or sell another ETF, and there you go. There are some new types of ETFs that are coming to market, which I'm really interested in as well, when we look at Royal London, is an ETF of ETFs. So,
oh my goodness, if you haven't got ETFs, then you're ETFs of ETFs,
Again, a professionally managed ETF, which has a bit of, multi-assets. So, the traditional 60-40 split, which, is 60% in bonds, 40% in equities, and how you can play around with that. And so you create these balanced portfolios in a single ETF. So you buy one ETF and then you get this very diverse cross-asset like exposure. And then you can kind of increase the aggressiveness. So if you're a younger investor, for example, like my kid's age, 100% equities, right? And emerging markets, because, you've got the time to sit through and that's where the risk and return makes sense. But if you're a little bit older like me, maybe you want to have more bonds, right? And so you want to be thinking about your retirement. And so you can actually create these ETFs of ETFs that are effectively a strategy, a multi-asset strategy that fit your profile. So they're just building blocks.
And they'd still be as transparent. They'd still...
Yeah, 100%. Yeah, exactly that. I mean, you can see...
Just because anybody hears all of these sort of financial chicaneries and adding this and that, you think financial crisis, CDOs, all these sort of mixing things about. And so my brain is like, oh, I don't know.
Yeah, no, that's certainly
nothing
like
that. Good to hear.
But yeah, I understand. It does sound... Sometimes it sounds a bit complicated, but it's really not. I just think of it as building blocks, like Lego, and you just go, okay, I want a bit of that, a bit of that, and a bit of that. Like what you've done. I think what you've done with your portfolio is spot on, right? You just play around with it. You can see exactly what's in it, and you don't need too many. You don't need. I mean, and the other thing is, I think, we always someone I was speaking to recently said, "Oh, they're high frequency, aren't they? Because they're traded on exchange." Like, no.
What do you mean by high frequency?
High frequency, you trade in and out. You trade constantly trading them. Yeah, and that's not the point. Right. And again, Jack Bogle famously, Vanguard, didn't want to introduce ETFs because that was against his principle. His principle was cheap, low-cost investing and just walk away, and just don't touch it, don't think about it, and just leave it to do its thing. And that's, I think, the same is true with ETFs. The fact that you can trade them on the exchange doesn't mean that you should, and I think it's just about the way in which you get into these is easier and more transparent, but you shouldn't be trading in and out. And I think that just sitting on the exposure, monitoring it, but resisting the temptation to buy and sell them frequently, I think is a bit of a pitfall that we often see. But that's just the education. I think just these are funds, treat them like any other fund, and buy them as a long-term investment.
Now, I appreciate you love your job, you love what you do, you love a good ETF. However, I do want to look over some of the sort of potential pitfalls with them. You mentioned one there, jumping in and out. We spoke about my all world, which was 62% US, 30% tech. If we have some, crash, then I will notice. But is there not an issue, particularly with these sort of trackers? I know you can put lots of different things in them, but let's focus on those because they're presumably the most popular.
Yeah.
That are we not rewarding the big companies to get bigger? And then what happens with the little companies? Yeah,
it's something that is spoken about a lot, I think. And actually, yes. And it's not just the ETF, clearly. There's a lot of tracker type products, and the ETF is a famous version of that. And yes, I think there's an element of truth to that, right? If you're just simply mirroring what the big companies just get bigger, but the counter argument to that, and the reason why I think it's an interesting time is, well, the way you profit from that is by active managers do effectively can trade around that. Active managers are, they're paid to pick these and spot these dislocations, these opportunities. If these companies are getting a bit too big, and they're getting too big not because of what they're doing, they're just because people are blindly tracking them, and so that then creates a big opportunity for the active managers. And that's why I think the active management story when it comes to the ETF is really interesting, because you now have these stock pickers, these very smart people who can spot these opportunities to make money from these types of dislocations, as I say. So I do think that it's not necessarily a concern for me, because I think that if this is happening, then that just creates another opportunity elsewhere, and that's where the active management was coming in.
Simon, what do you think about? Because we do hear it quite a lot, don't we? Just get yourself an ETF, and all, well, stick your money in, leave it, forget about it, carry on.
Well, I mean, arguably that's what you should do, because
where are ETFs in your portfolio?
You're just
Simon?
well, there you go. Yeah, and if my portfolio consisted of just one global stock market ETF, I probably would have more money in my portfolio than I actually do, okay? Because I'm the kind of idiot who's decided that I can pick some winning shares and I can pick some fund managers who can pick some winning shares, who, as it turns out, it's very hard to do that consistently.
Yeah.
Then I probably would have just been better off just letting the market do its work, because the conditions that we have been in for most of the last decade have been very favourable to letting the market just do its work.
Yeah.
There will come a point when those conditions change, and then it will be very interesting to see what happens in the next 5 or 10 years after that. Maybe things will just continue as they have done, and just letting the market do its work will continue to be the right thing to do. Or maybe we will see a return of active management. And that's where I think some of the stuff around some of the active ETFs becomes quite interesting, where they're taking, for example, an index, and then they're saying, well, we're not going to just follow that index, market cap weighted. So the biggest companies are the biggest holdings and so on. We're going to tweak this, we're going to tweak that, we're going to do that. So,
which may mean I don't have to have those other ETFs to balance the ETFs that I think is imbalanced.
You're taking an active approach, but in a different way to what we traditionally think of having a fund manager who's trying to pick winners. But then you'll also have fund managers, and that's what I think would also be interesting, who will be looking at it and going, okay, well, because as Steve said, if you are going to launch an active fund now, you're probably looking at it and going, well, everybody's buying ETFs, so let's do it that way. In the same way that people are releasing movies straight to Netflix, and not into the cinema. I mean, arguably, depending on what you're investing in, the best structure to invest in is an investment trust, but they're seen as quite old-fashioned. But if you are investing in less liquid investments, smaller companies, or certainly anything that is like a physical investment, then maybe you're better off with that. But I think it's horses for courses.
It really is, yeah.
Just explain investment trusts. Why are they seen as old-fashioned? What are they? What do they do? Why are they different from this? I want to get to the point of why you would pick an ETF, especially when we're talking about active here, over the other options.
An investment trust also pools investors' money and is also listed on the stock exchange. So you buy and sell the shares just like you would do ordinary shares. The chief difference with an investment trust is that there are two prices, the share price and the net asset value, and those can trade at a premium or a discount.
Net asset
depending
value?
on, that's the value of all the things in there added together, right? So I've got a basket of stuff, right? And if you took all of the things in that basket and added it together, it's worth X.
Right.
But then there's also a separate price. There's price Y, which is what you're willing to pay me for that basket of stuff.
Right. So
Now, if you think the stuff in that basket is really good, then you might offer me a higher price for that basket. But if you think the stuff in that basket isn't great, or actually you're feeling a bit worried about things at the moment, and you think, well, I don't think anybody's going to buy that basket off me for more money, you might offer me less. And you can get a gap there, a discount or a premium. Now, as Steve said, you can also get that with ETFs, but ETFs tend to trade around. The aim of the game with ETFs is to try to stay at the right price, to not have the discount, the premium. Whereas with investment trusts, discounts and premiums are very, very common indeed. And they can also borrow money to invest, known as gearing, which can increase the returns in the good times and decrease the returns in the bad times. But what they aren't is they're not, investment trusts aren't forced sellers or forced buyers. So when the money rushes in, they don't have to go out and buy a load of assets, which an investment fund would need to do. And when the money rushes out, they don't have to sell them to fund the redemptions, which a traditional investment fund would need to do.
Yeah.
So to put that question to you as well, Steve, with the active sort of market, I suppose, growing for ETFs, why would you pick an ETF over any other option? And I want to also throw into the mix with that cost. Traditionally, ETFs are seen as very low cost, and presumably because the most famous ones are the ones that just do the passive. Exactly right.
Yeah.
Are we going to see a sort of change in that attitude if there's more active investing going on with ETFs, that actually the costs are going to rise?
Yeah. So to answer, the first question, why? I think it's to those points that I made earlier. It's just the convenience. I think that probably very similar to me. We do everything on our phones. All my banking's on my phone. It's just what we're used to now. Certainly my kids, as we mentioned, everything's on their phone. So the ETF is digital compatible. So that's why I think it's that point of easy accessibility, convenience. So that's the why. To the question around cost, I completely agree. So there's a finite number of benchmarks out there. You've got the S&P for the US, you've got the FTSE 100. These are the league tables, the premier leagues of the various countries, as I say. So you'll have different issuers launching the exact same fund because they're doing the exact same thing. The fund manager is just copying what the index does. So you could end up with, and this is certainly the case of the US being the biggest market in the world, you've got 30 plus S&P ETFs. And if they're all doing the same thing, which one do you pick? The cheapest, obviously.
Right.
If one's 4 basis points and one's 40 basis points, well, that's a waste of money, and that one's the one you should pick. And that's it. So
then how do the others keep going if it's...
It's a good question. That was quite an extreme example.
Right.
They're probably 7 versus 4 or something of that nature, and people either are happy to live with that difference. Maybe there are other considerations like the spreads. Now, the spread is effectively the difference between the bid and the offer, the buy and the sell price that we would see on the exchange. So if you're buying an ETF, you need to look at the offer price, and that's the price that you're going to pay. If you're looking to sell it, then it's the bid. The difference between the two is what we call the spread. And that's also another important consideration, because clearly if the bid offer spread is quite big versus another ETF, which is quite small, then you need to factor that into your cost as well. So these are the other important considerations is if I'm buying and selling, what's the spread? Because you will end up paying that. So for passive, cost is everything. And that's why, again, ETFs have become synonymous with cost effective. But that isn't necessarily the case. You're paying for something quite different with an active. You're paying for that fund manager's decision and their knowledge and their skill. So I do think that the battleground is slightly different. Passive, it's all about cost.
That's a really good point, though.
Yeah.
Just to hold you there for a second, is it just down to cost, or is there something about... So I've obviously got Vanguard. Presumably, there's lots of other options that I could have gone for that.
Yeah.
But I went with the name.
Yeah.
Which I'm sure a lot of people do, right? It's something
Absolutely.
I recognise, and is there something to be said for that, or are they literally the same? It doesn't really matter.
I think for those big blue chip, as we call it, benchmarks like the S&P or the world, then there's nothing in it. I mean, they're all there may be some slight differences in terms of there may be some stock lending that's happening within the fund. There's also, and I don't want to overcomplicate it. So we have 2 types of ETFs. You have physical and synthetic in Europe. Physical is you physically go and buy. So the fund manager just goes and buys, let's take the FTSE 100 again. They go and buy the FTSE 100 and they stick it in the right weightings into their portfolio, and that's that.
Right.
And then they track it, monitor it, and trade it. A synthetic ETF is actually slightly different in that you the exposure or the performance that the fund manager is looking to achieve against their benchmark is delivered through a swap with typically a bank who's providing that. So this is more common, I'd say, in tricky to, like if you've got emerging market exposure or where actually doing the physical is actually quite expensive or quite difficult, or there's a benefit. For example, there's what we would call an outperformance through a tax or something that the bank can pass on. So
there's sort of a guess.
No, you can find this out. You can find it out on the kids and the fact sheets and do your homework a little bit and just go, okay, it will be very obvious because they have to make it very clear. This is a synthetically replicated benchmark. So there are some slight nuances, but for the most part, these all kind of do the same thing, and some will therefore potentially do better than others as a result of that. So yeah, do a little bit of homework, I think, and just look for those key things like, is it synthetic, is it physical, do they lend? It should all be spelled out certainly in terms of the fact sheets and the prospectuses, or just speak to the issuers, right? They're on hand to answer these questions. You can probably do it on ChatGPT now and just inquire, and is this a synthetic? And it will come back, and I'm sure it will say, yes, it is, and this is how it's amazing.
I mean, get ChatGPT checked, but it's sometimes wrong,
wrong,
I wouldn't use it for financial advice, etc., etc.
No, but it's helpful for doing a bit of digging and a bit of homework.
Oh, absolutely, absolutely. I mean, especially when, and I mentioned there, what are there, 10, 12,000 ETFs out there?
Yeah, there's a
lot in that.
There's a lot, yeah.
Yeah. So, I mean, how do you even wade through that beyond I want world, I want emerging markets or whatever? Like, how do you begin to think about pulling all these together and building some sort of portfolio if that's what you want to do?
Yeah, I admit that it's it's a bit messy, but there are tools that you can use. So there are tools available online, I think for the most part free for end investors, where you can effectively filter the information. So you could say, for example, I want a UK equity ETF that will massively reduce it. I'm not just interested in the FTSE 100. I'm looking at the all share, for example. I want the mid cap, small cap as well. I want it physically replicated, not synthetic. And very quickly you will get down to a small number, if not a single product that actually meets your needs. So there's various different tools available that do that. Or you can be left with like a choice of 2 or 3. And then you can then go, okay, well, which is the cheapest? And then what's the spread like? Often you'll get the spread information, that important cost for getting in and out. That's an important consideration around total cost of ownership. So those two things combined are important. So I think very quickly you can get down and narrow it to a very small number, if not a single product, by using those tools. If you are still stuck and you're then just maybe reach out to the issuers and just get some information from them. They're pretty good at helping and giving you the information around the different types of products and the benefits, etc. But there are tools available to help you navigate this forest of information that we've created for ourselves.
Simon?
So obviously what Steve said, and as well, if you go to your investment platform or any investment platform, it doesn't even need to be your own investment platform. Just look up an investment platform and they will have a list of cheap ETFs for the major markets, and their experts will have gone through them and done all of that work that Steve was talking about there. So if you don't want to put your details in and answer some questions, just read what they're saying and look at a couple of them, and jobs are good one, basically.
Super.
It's a hotbed of competition, right? People are literally falling over themselves to compete.
Who's creating these? Companies like yourself? I mean, who creates them?
So asset managers create them.
Can I create one?
No.
Oh, okay. I mean, I don't know what I do with it, to be honest. But
you know those rules and regulations we were talking about
Would
earlier?
I not get a UCITS?
Some in those rules and regulations, there's a bit that says you can't just make one.
It's actually quite hard to make an ETF.
Is
I have
it?
to know. Yeah,
How do you make an ETF?
Yeah, well, it's complicated.
Bit of that.
Yeah, a bit of magic. Yeah, no. You need all the ingredients. You need to set up the legal fund structure. You need a management company, a board. I mean, there's a lot. Yeah, it's not straightforward. Yeah, you can do it.
I want to ask you what you think the biggest mistakes that people make when it comes to ETFs. And with that, it might be perhaps biggest misconceptions. What do people keep doing that frustrate you as the expert?
Being too active, I think, and trading too frequently. Also, and this is perhaps more not necessarily for retail, but sometimes when we see how the execution is done, the important thing about an ETF is that you create this ability to trade on the exchange. Then you have this, you can use all these execution tools that are available to you. But sometimes the ETFs, the way in which they're traded is not sensible. So I'll give you an example. If you're trading a US ETF, it's always better to wait till the US is in the afternoon. So whilst you can trade that at 9 o'clock in the morning, if you're not up against it, if you didn't need to trade then, if you don't have a view on risk of where the market's going to go, it's always better to wait because the market is just much more liquid when the underlying market's open. So these are the things that I think. But I mean, the market is so mature now and the liquidity is so deep and to your point, right, the point of an authorized participant or these market makers is they arbitrage. If an ETF does start trading too cheap or too rich, then that's just profit for them. So as a result, the ETFs are trading so efficiently within their bounds, very tight spreads typically, certainly the very liquid ETFs. And that's just because the market is 25 years old in Europe now and very, very mature, which is why we're now going, what else can we use this for?
Is there any time that an investor shouldn't use an ETF, do you think?
So the investment trust, I think that they may offer the solution for potentially property, for example, or private equity and other things where there's less liquidity in the underlying, and because you have that control. And if you want to buy gold, you can't buy an ETF, as we've said, you need to buy ETCs. So for the most part, the ETF being this technology that delivers greater utility, convenience, all those other things, I think that it will, for the most part, replace the older technology, the mutual fund, as we call it, the traditional fund. But there are certain holdings and positions and strategies that are not suitable, and they're not suitable for UCITS, or they're not suitable for in terms of liquidity, as we said. So it is horses for courses, to take your expression. I do think that the ETF will sit alongside all these other types of investment vehicles because there's a need for them. And so it's just picking when the ETF is the right structure. It will, I think, typically win out, but it's not for everything.
So do you see a scenario where maybe gradually over the next 10 to 20 years, ETFs start to replace the traditional investment fund world?
I do. And we're seeing that massively in the US. I would imagine that over the last 5 years, you've probably seen a well over 5 trillion move from mutual fund to ETF. The US is a bit of a unique case because there is a tax advantage for owning for an ETF versus a traditional fund. So that's really accelerated it in the US, in my opinion, and acted as a catalyst. But nevertheless, it's kind of the convenience point is still really important for US holders if you speak to them. So as I say, we're always 5-10 years behind the US, and we're starting to see that now. I mean, Germany is a good example in Europe, actually, where you're seeing this accelerate. The UK is probably the laggard in all of Europe in terms of that conversion. But yes, I do think that's the path we're on. It's because the technology that the ETF delivers, that convenience and utility, there's a reason for that. Going back to the example of my kids, right? They're thinking and trading ETFs because they have them on their phones, and they're digital compatible. So it's the future of how I think we're all going to be thinking about managing our investments and hopefully our pensions. We should be encouraging people to think about their own financial resilience and taking control and being confident enough to do it. And I think the ETF is just a part of that. It's a small part of that whole thing that we as a country need to get our heads around, that we need to be more confident and take ownership of our own finances.
And in a increasingly global investment world, one where people are just as likely to open up their investing app and buy a US share as they are to buy a UK share, do you think we'll move towards a scenario where we can start buying US ETFs, where the US ETFs and the European ETFs start to move together? Or is it always going to be a big no-no? Because I think that's a frustration for a lot of UK investors, isn't it?
It's more regulation, so it's not permitted. The US asset managers aren't permitted to sell to European. In actual fact, if you think about who are the big players, they're US ETF issuers. So they just replicate the same strategies in Europe and they list them as UCITS. So whilst they're typically bigger funds, because the US is the US and it's a massive market, that shouldn't. I mean, you have the same choice when it comes to these products in Europe as in the US. Okay, they're bigger, but the liquidity is exactly the same regardless, because the liquidity is of course driven by the underlying market. So an S&P fund here in the US, here in Europe versus US, the liquidity profile is identical. So just because one's bigger than the other doesn't mean it's any different. So I think people are starting to understand that a little bit more, and actually the European funds are getting so big now that people aren't even questioning it. So I don't see that that's massively a need, actually, that we have the ability to trade US ETFs, and I think we have the same availability and the same choice now anyway.
Tempted, Simon, to add one? Yeah, fair enough. Steve, thank you so much. Before we let you go, the £1,000 move, if you had an unexpected £1,000, what would you do with it?
So I recently bought a camper van,
Right.
which I love. And so I would probably just, take it, just book some campsites. I love camping, going around England and Scotland.
Lovely, yeah.
I'd like to do Ireland, but I think next trip will be Wales. So maybe just to book some campsites in Wales and take myself off I should take my wife as well, but the two of us off with the dogs for a week in Wales.
Lovely.
Like that.
And then France and Italy, and you've done the Six Nations.
Yeah,
brilliant.
Exactly.
Simon says.
Well, I think as Steve so eloquently explained, ETFs can be an incredibly simple way of investing. And if you just do one thing and buy a global stock market ETF, and you hold it for 5 to 10 years, it's probably going to be the best and cheapest way that you have a chance of getting richer. And you don't need to overcomplicate it. You don't need to worry so much about the alphabet soup or all those other things. You just buy that one simple ETF, or maybe another couple of simple ETFs that go with it, and you can just do it all very easily. And there's a whole world that you could get interested in. But if you just do that simple stuff, then at least you'll be on the right footing.
Simon, thank you so much. And thank you, Steve. And thank you for joining us. If you want to get in touch with us, you can find us on social or just send us an email. Remember to hit subscribe so you don't miss an episode, and make sure to tell your friends who don't know their ETFs from their ETCs about us as well. Before you go, just a quick reminder that everything you've heard on this podcast is for information and education only. It's not personal financial advice. Investing involves risk. And if you're unsure, it's best to speak to a regulated financial advisor. If you enjoy Investing Unlocked, especially our retirement episode, then I think you'll enjoy this from our sponsor Pension Bee, the Pension Confident podcast, hosted by Philippa Lamb alongside a panel of financial experts. It's aimed at those who want to understand pensions and personal finance in a bit more depth, but without the jargon. They cover topics like ISAs, mortgages, the bank of mum and dad, as well as how to become a pension millionaire and the cost of divorce. There are new episodes every month, plus bonus content in between. You can listen on all major podcast platforms, in the Pension Bee app, or watch on YouTube. Just remember, anything discussed isn't financial advice, and when investing, your capital is at risk. Search the Pension Confident podcast wherever you listen.